Hello and welcome to this edition of Money in Motion video blog. This is Dan Perkins and thanks for watching. Today we're going to talk about our three keys because there's been some very, very significant developments that I need to bring to your attention because they have implications for the markets and the economy longer term. So let's look at treasuries first. We've been following the 10-year and you can see in this chart, this is what's happened to yields on the 10-year treasury over the last few months. The Federal Reserve has stopped their quantitative easing purchases and now the free market is beginning to take over. No real significant changes in interest rates, which is a sign that the demand for credit, now that the government's no longer buying the debt, the demand for credit will be driven primarily by the private sector, although the government on the Treasury side will be selling a lot of debt because we're running at a deficit in the United States on our operating budgets, and so we'll need to borrow more money. The next chart is the price of crude oil. As you can see on this chart, we've seen a precipitous decline to in the $77, $78 level on crude oil. Why is this important? Well, it's important because not only does the price of gasoline at the pump come down, now below $3 most on a national basis. I think, as I said before, I thought crude oil could fall to about $70 to $71 a barrel in this run. American crude oil at $77 a barrel and Brent North Sea crude at around 82 are both below the all-in production costs for both OPEC and Saudi Arabia. OPEC needs about $90 a barrel to break even. Saudi Arabia needs about 85. So at $78 a barrel, the governments of OPEC and Saudi Arabia are now losing money for every barrel of oil that they pump. Now, that means that if we can get our Congress, our new Congress, to lift the ban on the exportation of raw crude oil, then America not only becomes energy independent, but could become one of the largest exporters of crude oil around the world. There is a great deal of talk that the new Congress, when it comes in session, either lame duck or beginning of the new session in January, will in fact pass the Keystone Pipeline, which will bring Canadian tar sands oil to the United States into Texas for refining. We will be in a position then to export finished product in addition to raw crude. If you think about the idea that crude oil could go to $70 a barrel, you'll understand why I am concerned about deflation in the American economy. Just think about a gallon of crude oil, all the things that affect our life that are made out of crude oil or petrochemicals. Clothing, cars, containers. Crude oil is everywhere. And so whether it's a petroleum distillate or however it is, it's very important. So that what we're going to see is that if we stay in this $77 range, we will begin to see not only gasoline prices continue to fall, but we will see other commodities and other products prices begin to fall, which means we have lower prices than what we had before, and as a result, we have deflation. I think that we have the ability, if we get rid of the ban on the export of crude oil, and by the way, you should know that ExxonMobil already decided to sell some of its excess crude in the United States in an overseas market, and so far the administration has done nothing about it. So that if we get rid of this ban and we can begin to export, then we have a reason for us to expand our infrastructure, our refining capacity, our storage capacity, and our pipelines to carry crude oil and finished product to various ports around the United States for export to other parts of the world. This puts tens of millions of people to work in very good paying jobs, and as a result we become a geopolitical power using energy as our weapon as opposed to our military. I really think that could happen, and I believe we're in for a significant period of time of deflation where prices are going to fall in the United States. And at the same time, we're going to expand our economy by putting more and more people to work. So when I say to you that we're looking at deflation, the next chart pretty much confirms that story. The last thing that we look at is our triumphant is the price of gold. And here you can see that gold on this price of this chart has dropped to a 5-year low. Gold is perceived to be an inflationary asset. Protect your money against inflation. As a result, if you have a period of deflation, then inflationary assets are going to be worth less. And this is exactly what you're seeing in the price of gold, the supposed perfect inflation hedge. I wouldn't be surprised if the price of gold doesn't drop another $100 to $150 an ounce to the 1,050 to 1,050 level before this is all said and done. So those people who have owned gold and inflationary assets are going to find themselves in a problem of losing money. The other thing that's very important to understand is that at $70 to $80 a barrel or less, the alternative forms of energy, wind, solar, no longer can compete on price because the fossil fuel energy will be so much cheaper. I really don't know how low oil can go, maybe 50, maybe even lower. If that happens, then these companies will find that there will be no market because they cannot come up with a rationale other than the environment to convince people to purchase solar panels and windmills and those kinds of things. So I think that industry is pretty much dead for a while. And so looking at our three, treasuries are basically unchanged, oil collapsing, gold collapsing, and the economy with an opportunity with a new Republican Congress to re-exert itself as a world power, but this time not on military strength, but on energy. And we're in a deflationary period that could be for an extended period of time. So I don't see any pressure on interest rates with deflation. I do see some potential further weakness in crude oil and in gold. And with deflation, things are going to get cheaper. But we just have to be careful that we understand that cheaper may not necessarily always be better. Now let's move to the stock market. Stock markets rallied just before the election. At one point we were down 10%. Now we've picked that all back up in a very short period of time. I believe that the markets were anticipating that the Republicans were going to get control of the Senate. I don't think the markets were anticipating how bad the drubbing was that the Democrats took last Tuesday night. So that the market rally is getting smaller and smaller. We're running into more and more resistance. So as I said to you in a couple of videos ago, I do believe that we're going to have to go back and test the most recent low, which is about another 10% from this level, just to see if it was a true bottom. I don't know when that's going to come, but it could come at any time, and it might come very quickly. We just have to be careful and watch. Lastly, I just want to talk a little bit about volatility, and it's picked up dramatically. Very wide swings, plus or minus 10% in a matter of a few weeks. Volatility is with us, especially as we go through this lame duck session of the Congress. I'm not expecting that we're going to get a whole lot done, but we could be surprised. So expect the volatility to continue. Expect the possibility of a retest of the most recent low to make sure that it's there. Prices are going to go up. Portfolios will change in value. But at the moment, it appears that pretty much all the dividends are secure, and I don't see any reason to change there. We do have cash. If we go back and retest, I would be a committer of cash into some new positions. So if you have questions about what's going on, please feel free to send me an email or give me a call. If you have friends that are looking for a real money manager, please feel free to give them my number and have them give me a call. This is Dan Perkins, and thanks for watching.